Hello everyone, welcome to another video for CFA. This video will be small and will be a continuation to the previous video because there was some technical glitch and we could not complete the return concept completely. So till yesterday we had done till money weighted rate of return. Okay. Today we will start with gross returns. What are gross return? What are net returns? So let us take an example to understand it better. Suppose I am an investor. Okay. Now, as an investor, suppose I make an investment of $1,000 into a fund which is managed by a fund manager. Okay. Suppose the fund management fees is $50. Okay. Now, this fund will make investment elsewhere in order to generate the return. Suppose in order to make this investment and get the return, it earned $1,120 and had to pay $20 as commission. In terms of transaction cost, in terms of charges, in terms of brokerage, and left with $1,100. Okay. Now, since it has got $1,100 and $50 is the management fees, the amount which investor gets is $1,050. So this is the entire transaction. Now, what is gross fees? In this situation, gross return will be 1,100 divided by 1,000 minus 1,000 into 100, which is 10%. So you see, in computing the gross return, the management expenses were not excluded, but the expenses which is needed to earn that return was included. Okay. So you see, in computing the gross return, the management expenses which were incurred at the fund level were not included. However, the expenses which were incurred in the form of commission or brokerage or anything which is used for earning that return was considered. Okay. On the other hand, the net return would be $1,100 minus $1,000 minus $50 divided by 1,000 into 100, which is 5%. Okay. So basically, what did we see? In gross return, it is return before management fees. Return before management fees. Okay. But after commission and brokerage. Okay. Or in other words, any expense directly attributable to earning that return. Any expense directly attributable to earning that return. To earn that return. Okay, any expense directly attributable to earn that return. On the other hand, net return, a return after deducting all expenses. After deducting all expenses. Are we clear, guys? This is the gross and net return what we wanted to discuss. So let us see what is written over here. What is gross return? The total return on a security portfolio before deducting for fees, management and admin cost. Yes, we have already seen this. What is gross return? What is net return? Net return is gross return minus fees. However, an important point to note, commissions and other costs that are needed to generate the returns. So basically, needed to generate the returns means directly attributable directly attributable are deducted in both gross and net return. Are we clear? Then we come to the nominal and real return. If you want to understand the concept of nominal and real return in a more better manner, in a more enhanced manner, I would suggest you refer my time value of money video. In this, we have taken 3-4 classes to understand the entire time value, and it is very important for you. You can watch that. There is a separate playlist as well for this on the YouTube. Okay. What is pre-tax return? It is very simple. Returns before taxes. What is post-tax return? Return after taxes. Real return. Nominal return adjusted for inflation. Okay. The last and the topic which we have to see is the leveraged return. Okay. First, we will read the definition and then we will take up an example. Rate of return to an investor, that is a multiple of the return on the underlying asset, calculated as a gain or loss on the investment as a percentage of investors' cash investment. Percentage of investors' cash investment. Okay. Now let us understand what it is saying. Okay. We are understanding leveraged return. Mr. A has $1,000 which he wants to invest. Additionally, he borrows $2,000 at the rate 8% per annum for investment. The total investment done by A is $3,000 and Mr. A received $3,500 at the end of year 1. Compute the leveraged return. And compute the leveraged return. Okay. So what is the question? It is given that there is a person, Mr. A. He has $1,000 of own funds. He has own funds of $1,000 of $1,000. Okay. Plus borrowed funds of another $2,000 at the rate 8%. Okay. The amount that he received as a return on investment, or the amount which he received after a year, is $3,500. Yes. Now, can I say this entire amount of 3,500 belongs to him? Can I say the entire $3,500 belong to him? Will that statement be right? No, that statement will not be right. Why? Because out of this 3,500, he has to pay the amount which he has borrowed along with the interest. So, borrowings and the interest on borrowings have to be paid back. Borrowings were $2,000, and what was the interest on borrowing? It was 160. That is 8% of 2,000. Yes or no, guys? What I'm left with is 1340. Okay. So can I say by my cash investment of $1,000, I have earned 1340, because ideally originally I have earned 3,500, but out of that 3,500 I have to pay for my borrowing in terms of interest, and I have to repay back the money that I have borrowed. So what I'm left with? I'm left with just 1340. Out of the return that I have made, I have to pay the interest on borrowing, and as well as I have to pay the amount that I have borrowed, principal money. So can I say out of my cash investment of $1,000, which is my own funds, guys, remember, own funds. Okay, out of my investment of own funds, I was able to convert $1,000 into 1340. So leveraged return will be 1340 divided by 1000 minus 1000 into 100, which is nothing but 34%. Okay, so leveraged return means those returns which you earn on your cash investment and not on your total investment. Why? Because if you look at this example, your total investment was $3,000, correct? Out of which $1,000 was your own investment, whereas $2,000 was investment through borrowings, borrowing based investment. Okay, and the amount which I earned as a return was 3,500. But leverage return tells me that you earn, the return that you earn on your own investment is known as leverage return. Now, why is this concept important? This concept is important because a lot of places we don't upfront the entire amount of investment. We borrow the money and then we invest. There are a lot of places where we don't make upfront investment from our own pocket. There are people who are ready to fund us, they fund us, and we make investment. We only make a marginal amount of investment from our own money, and rest all is borrowed. In that situation, leveraged return becomes a very important metric. And that is why we have this concept of leveraged return. Okay, guys. Now let us read in order to understand whether it is making sense or not. What does leveraged return is saying? It is calculated as a gain or loss on the investment as a percentage to investors' cash investment. What is cash investment? Cash investment is nothing but own investment. Got it? And where it is used? It is also given that it is primarily used in case of derivative securities. Yes, we have seen this. Guys, we have seen it is used in case of derivative investments. Correct? Where we have seen that in derivatives there is a lot of cash settlement which is happening, and in those cash settlements a lot of margins are used, guys. Thus we have this concept of leverage return. So the video will be till this part only. It was meant to be attached with the previous video. However, there was some technical glitch because of which we were not able to. In the next video we will come out with risk measures. Okay guys, thank you and happy study.